Well, agriculture is the backbone of Uganda's economy, so we are told. And indeed, if you look at the number of people employed in this sector, there are quite many, and that is the reason. However, there are a number of dynamics that get that crown out of this sector, and this is issues like prices, the market availability for agricultural produce. Take the example of matoke farmers. Today, the prices of matoke have come down from highs of 15,000 to 20,000 shillings to lows of 1,000 to 2,000 shillings. But we'll be discussing that in some of our subsequent shows to really find out what is being done to address issues in the sector across the entire value chain from production to the marketplace. This is Money&Markets. Welcome to the show. I am Charles Ward, your host. Well, still talking about matters markets. Of course, today we're coming to you from one of the banana plantations. We've already talked about bananas and where they are today, but we want to stretch it a little better into the space of financial markets. Well, a couple of sectors have been suffering. Several markets of commodities have been suffering. The financial markets seem to be pointing in a different direction. To those that sit in this sector, there is a silver lining that is pointing to positive growth. Take a look.
Well, the markets have gone through turbulent times. We have not seen this before globally. But Uganda has had an interesting couple of months. From the start of the COVID scare in Uganda and the beginning of the lockdown in March, we saw a lot of volatility with the currency depreciating to levels of above 39.50 in a 2-week period, from levels of about 3,700. And then quickly, central bank stepped in to intervene and calmed down the markets. Since then, we have seen a lot of calm, I'll say, in the currency market specifically, which is quite strange because when you compare to the other currencies, the regional currencies, they have maintained a weakened stance. But Uganda has had positivity in that regard. A couple of factors. The first one was that with the lockdown coming into place, demand reduced. So there was some panic buying, let's say in March, where people were thinking, okay, we don't know where this thing is going. We've seen that with South African rand lose over 10%. We've seen the Kenya shilling lose over 4%. We've seen a lot of the African currencies depreciate. A lot of people rushed to buy in March and to protect themselves. But after the lockdown, demand kind of diminished. Why? The petroleum companies, for example, had already stocked up on supplies, and then transport is halted. So that means there is no demand. Because people are locked up at home and they're not moving from one place to the other, even the fast moving consumer goods slowed down. So the people who are manufacturing those detergents, soaps, cooking oil, all of those saw a shrinkage in demand because people are now locked down. But more recently, what we have seen is that there has been what we call a risk of sentiment, meaning that before COVID or at the start of COVID, investors were afraid and were taking out their capital and taking it to safe havens of the more developed markets. Now, with easing of lockdowns in many countries and also beginning to ease the lockdown in Uganda, we see a resumption of economic activity and people trying to take advantage of good deals. So in the financial markets, you've had stories of China buying up a lot of stocks. You've had even in the UK and the US, a lot of investors picking up stocks which they think were fairly cheap. Even in Uganda, when you look at it, the 10-year was at 16%. We had an auction, it was oversubscribed by over 2 times, and it came to below 15%. By the end of the week, the 10-year, which was trading at 16, was trading at 14.5 or lower. You know what drove that? I mean, the offshore interest. So the offshore people who had stayed out of the market and thought, it's risky being in this market, now realize, look, growth is going to be low, inflation is going to be below 5%. If the currency does not depreciate and remain stable the way it has, it means that this is a good investment opportunity. And so we saw an influx of foreign investors. That has helped the currency significantly. Things may not immediately return to normal, but there will definitely be an improvement. Do we expect by the end of 2020 to have growth levels of 5%? No. Right now, growth levels may be quite low. We think that maybe by the end of the year, there will be a slight pickup. So if activity dropped by 50% because of COVID or 30%, we can assume that maybe by December it will move back up to 70%, let's say, of post-COVID levels, but that is highly dependent on the factors and the sector. Yeah, if you're looking at tourism, as long as the flights are not open, as long as tourists are not allowed to travel freely, then you won't see that influx of tourists coming in, which means that that dollar inflow we're counting on and that activity coming from the tourism sector, whether it's hotels, lodges, and transport affected by tourism, that pickup won't come as much. However, if you're looking at the local sectors like local consumption of fast-moving consumer goods and petroleum products, that may definitely pick up to 70% or 60% of post-COVID levels by the end of the year.
Well, still talking about markets, let's look at the matoke farmers in Western Uganda who are today struggling with a collapse of prices for matoke. Of course, we've already heard that the prices have fallen from highs of about 15,000 shillings to lows of 1,000 shillings a bunch of matoke. Let's try to find out what could be the reasons behind this state of affairs and what can be done to get ourselves out of this slump. The plight of matoke farmers in Western Uganda has once again brought to the fore the missing link in Uganda's agricultural value chain, one of them being markets. According to reports, matoke prices have dropped on average from 15,000 shillings a bunch to 1,000 shillings in Western Uganda, driven by the chilling impact of the COVID-19 pandemic on matoke markets. The same plight earlier on at the beginning of this year befell dairy farmers who witnessed the prices of milk come down from 1,500 shillings a litre to lows of 300 shillings in the same part of the country. This followed the imposition of non-tariff barriers on Ugandan dairy products by Kenya, a major market for Uganda and a critical market for Ugandan dairy export-focused companies like Pearl Dairies. The farmers' misfortunes were again shared by grain farmers a year ago when prices hit rock bottom, this time as a result of bumper harvest for maize, leading to a spike in supply, chasing limited demand at the time. To experts, these realities point to the underdevelopment and in most cases sheer absence of critical supply chain ingredients for the agriculture sector, including storage facilities, validation plants, and well-structured markets internally and externally. This is worsened by the risk-averseness of financial institutions towards lending to agriculture, exposing farmers to market vagaries and exploitative middlemen that dot the agricultural value chain today. A 2018 World Bank report on agriculture identifies 3 priority areas for policy action and investment for the country to realize its full potential in the sector. Key among these include validation through commercialization and trade, then strengthen public institutions and policy geared towards supporting the sector. So as the country places emphasis on agriculture production and productivity, the same vigor should be extended to building supportive soft and hard infrastructure like storage and financial facilities respectively. The picture can be completed with building and lobbying for well-structured markets for the country's produce beyond Uganda's confines. It's time to take a very short commercial break. Don't go away.